this is John Burke, and today I'm going to discuss gross domestic product, or GDP. I know that everyone is familiar with the term and knows a great deal about it, but I want to go through it in a bit of detail and perhaps correct some misconceptions that you may have about gross domestic product. So first, the origin. It has its origin in the 17th century in what is called political arithmetic. This is a term coined by an Englishman named William Petty, and he was the first to calculate national income. So we can say that the precursor of GDP is political arithmetic. And what was important about Petty's work, he was the first to calculate national wealth based on national expenditure, and leading to a fundamental equation identity where income is equal to expenditure, expenditure is equal to income. And of course, income and expenditure are two of the ways that we use to calculate GDP within a particular economy. The term GDP came into its own in the early 20th century through the work of economists such as Kuznets and Keynes. So gross domestic product, what does it do? It calculates the value, so it's the total value of all final, so we're not dealing with intermediate goods, of all final goods and services produced domestically or within a particular economy. And as I said, it can be calculated in three ways. One would be the production approach, where we're going to calculate the value of all output. Another is the expenditure approach, where we look at what different sectors in the economy spend or consume. Or the income approach, which is someone's spending is always another person's income. Okay, the term itself, gross. So we do not take into account the depreciation or impairment of value of goods or the capital goods that were used to produce the products and services that make up GDP. If we were to do this, probably we would have to deduct about 10% from GDP to get net domestic product. Domestic, what do we mean by this? So it means that what we are doing is everything within a single economic zone that is produced, whether it's a product or a service within that single economic zone. This is what we're counting, regardless of the nationality of the individual that is the final goods or service. All right, so we have three approaches, as I said, and the most popular approach, or the one that we see most often used in economic textbooks, is the expenditure approach. And we have the following equation: gross domestic product equals consumption plus investment plus government expenditures plus net exports. So let's take a look at each one of these terms. So consumption, personal consumption expenditures. These are household expenditures for durable, non-durable consumer goods and services. Investment, gross private investment. These are business expenditures for newly produced capital goods such as machinery, equipment, tools, buildings, addition to inventory. And government purchases. These are government expenditures to acquire goods and services that the government consumes to provide public goods or public capital for the benefit of its residents. Then we have net export, X&M. So exports are goods or services produced domestically but sold abroad. M, by contrast, goods or services produced abroad and sold domestically. What's interesting to note, unlike the other categories that we've seen, with exports and imports, we do count for intermediate goods. All right, real GDP. So prices change. So we have nominal value of GDP, which is current prices. It has to be adjusted for inflation. Otherwise, a rise in prices alone would appear to lead to an expansion of GDP, which would be very misleading. So economists generally use a GDP deflator, which is a statistical tool to adjust nominal prices or current prices to a constant price. Then, of course, we get the difficulty of how can we compare the GDP of two countries, because GDP is measured in the currency of the country in question. So comparison requires conversion to a single currency. Right? Because of the economic strength of the United States, generally the US dollar is used as the currency of comparison. But how do we get there exactly? So we can use one of two methods. We can use a market exchange rate or what's called purchasing power parity. Obviously, the market exchange rate does not need any explanation. But purchasing power parity, what does it mean? It's the rate at which the currency of one country would have to be converted into that of another country to buy the same amount of goods and services in each country. So when we look to, we measure the GDP using PPP, it has a different effect for advanced versus emerging economies. So emerging economies will have a greater gap between real GDP and PPP. Whereas advanced economies, the numbers will be fairly close. Why? It's due to non-tradable goods and services. These are goods and services that must be consumed or produced, like a haircut. We can't, export or import haircuts. All right, let's take a look at the effect of imports on GDP. Well, if we look at GDP by definition, imports can't have any effect because we're only trying to measure what is produced within a single economic zone. So if it's produced outside of this zone, it can't possibly affect the value of outputs within a given economic territory. But let's take an example, and we'll do the U.S. So the United States, a person in the United States, let's say a household or an individual, purchases a car that was manufactured and produced in another country and imported into the United States. And let's assume that this car cost $50,000 US. So if we use our expenditure approach, personal consumption would be increased by the expenditure of $50,000. But this car was not produced in the United States, so we can't count it as part of the GDP of the United States. So we correct for this problem by our net exports category, where we're going to deduct 50,000 because it's an import from our exports. Let's take another example. We'll use the same consumer, buys a automobile in the United States for $50,000, but that automobile contains 10,000 of imported parts. Again, personal consumption expenditure would be 50,000, but again, we're going to correct for this the value of the import by 10,000, so that we don't skew the concept that we're trying to ascertain, which is what final goods and services were produced within a single economic zone, such as the United States. Now let's go to a question: what GDP does not reveal? Well, it certainly doesn't reveal the standard of living within a particular economy or well-being. For example, increased output may have negative consequences. This can be in the form of environmental damage, noise. If there are high crime rates, if we produce security equipment, it's going to increase GDP, but it's certainly not going to increase your standard of living. And also, GDP doesn't speak to the distribution of wealth or the value of these final goods and services within a particular economy. there are other measures that do this. That's what I wanted to talk about today, a short video on GDP. If you like the video, please subscribe to the channel and give it a thumbs up. Thank you, and I hope to see you again with another video that I'll make in the near future. Goodbye.